Set 1920, question 1 part A. Iskandar need to present about the basic concept of financial management. A. State briefly explain the main component involved in defining general concept of finance. So finance is the art and science of managing money. It is concerned with the process, institution, market and instrument. The financial process involves the activities of inflow and outflow of the fund among individuals, business and government. Finance is defined as the management of money and includes activities such as investing, borrowing, lending, budgeting, saving and forecasting. So question B, explain the shareholder wealth maximization goal and how it can be measured. So the maximizing shareholder wealth properly consider cash flow, the timing of the cash flow and cash flow risk. It reflects the worth of the shareholder investment in the firm at any time. Cash flow refers to the movement of money into or out of a business. It represents the actual cash generated or used by the company in its operational, investing and financing activities. Maximizing shareholder wealth involves optimizing the company cash flow. This means ensuring a steady and positive stream of cash from operating activities, efficient use of cash in investment, and a prudent financing decision. The timing of cash flow refers to when a cash is received or paid out by the company. On to question C. Describe the nature of the principal-agent relationship between owners and manager. The principal-agent relationship between manager and owner, where owners as principal delegate authority to managers as agent to oversee financial operation. The ultimate goal is to align the divergent interests of these two parties to achieve the company overachieving objective. Owners typically aspire to maximize shareholder wealth, while manager may have a personal career goals or other motivation. To bridge this gap, mechanisms such as a performance-based incentive, transparent communication, and a robust governance structure are employed to ensure that managerial actions are conducive to the long-term success and value creation of the company. This alignment helps agency costs, including those associated with monitoring and potential conflict of interest, fostering an environment where both owner and manager work collaboratively towards the shared goal of optimizing the company's financial performance and sustainability.
My name is MUZAFFAR ZHARFAN bin Muhammad Zakwan, and I will continue to the question 1 part B, which is we need to discuss advantages and the limitations of using ratio analysis to evaluate company's performance. So here is advantages of ratio. Point number 1, simplifying complex figures and establishing relationships. Ratios make it easier to understand complicated accounting figures and see how they are related. They help summarize financial information effectively and evaluate things like managerial efficiency, a company's ability to borrow money, and its earning potential. Point number 2, useful comparison in analysis. Ratios are not just calculated for 1 year. When multiple years of figures are compared, they help to identify trends in the business. Understanding these trends can be helpful in making predictions about the future of the business, which is very useful. Point number 3, assist in gauging decision effectiveness. Ratio analysis helps determine if a business has made the right choice in how it operates, invests, and finance. It shows how much these decisions have contributed to improving the overall performance. So we move to the limitation of ratio analysis. Point number 1, based on past information. Ratio analysis uses actual historical data for analysis. It is important to note that past results may not necessarily continue in the future. However, you can still use ratio analysis on projected pro forma information and compare it to historical data for consistency. Point number 2, difference between past and present costs. The income statement shows information in current costs or very close to it, while some elements of the balance sheet may show historical costs, which could be significantly different from current costs. This difference can lead to unusual ratio results. And the last point, combining information. The data in financial statement line item that you are using for ratio analysis may have been combined differently in the past, making it difficult to compare the information consistently over a period of time when analyzing trends.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad NAUSYAD bin Sharif and I'll be continuing the question 2 part A. This question, Daniel plans to spend his vacation touring Europe at an estimated cost of 34,000. To finance this trip, Daniel plans to make an annual deposit of 3,500 into a saving account at the end of the age of the next 7 years. So the first deposit will occur 1 year from today and the account pays 8% annual interest. So the question asks, will Daniel's account balance in 7 years be enough to pay for the trip? So in this question, we need to know whether the FV is in the next 7 years is enough to pay for the trip. So the PMT is 3,500 because Daniel will pay an annual deposit of 3,500. And the N is 7 because we need to know the balance in 7 years be enough or not. And the I will be 8% because the saving account pays 8% annual interest. So using the calculator, the FV will be RM 31,229.81 cent. So the account balance is not enough to pay for the trip. He needs an additional 2,770.19 to cover the cost of the trip, which is 34,000. For the next question, suppose Daniel increased his annual deposit from 3,500 to 3,700. How large will his account be after 7 years? So for this question, we need to change the PMT to 3,500 and still we need to calculate the FV in the next 7 years. So PMT will be RM 3,700 and will equal to 7, I equal to 8% and the FV in the next 7 years will be RM 33,014.37 cent. So still he cannot cover the cost of the trip, which is 34,000. Moving on to the last sub question, if Daniel can only make the same annual deposit of 3,500, provide two potential suggestions with evidence in order to assist Daniel to achieve his plan for a vacation in Europe. My first suggestion is Daniel can invest at a higher rate of interest of 11% bank account to achieve its target. So we need to know the PMT is 3,500 and equal to 7 and we need to change the I to 11%. So using the calculator, the FV in the next 7 years will be RM 34,241.46 cent. So the balance is enough to pay for the cost of his trip, 34,000. The next suggestion is Daniel has to wait a bit longer before he can travel, which is 7.47 years in the same account that offers 8% interest rate to accumulate 34,000. So Daniel need to wait to the end will be 7.47 years. So FV will be negative because we solve for the end. So FV, the future value of the money that we need to achieve is 34,000. So FV is equal to negative 34,000. PMT is 3,500 and the same I is equal to 8%. So using the calculator, the 34,000 will be achieved in the next 7.47 years. So the balance is enough to pay for the cost of his trip.
Okay, next is the question to part B. The table below gives information of the amount invested and beta coefficients for three stocks, HRM, BHP and IPG. Amount invested for HRM is 10,000, BHP 10,000 and IPG is 20,000. For the beta, HRM is 1.0, BHP is 1.2 and IPG 0.7. Okay, the first subcom question is about based on the given information, using the capital asset pricing model (CAPM), calculate the required rate of return of the portfolio. If the expected return for the market is 9% and the risk-free rate is 3%. Okay, using the CAPM formula, we need to find the risk-free rate, return market, and beta. So all of the information they're given right. So we just follow it. Okay, to the formula CAPM is risk-free rate plus with beta multiply with return market minus with minus with risk-free return. Okay, then so after we using this formula, I got for the HRM is 0.09, BHP I got 0.102, and IPG I got 0.072. After we use the CAPM formula, we need to find the portfolio. Okay, because the question want to the required rate of return of the portfolio, right? So for the formula portfolio, amount invested HRM multiply with the required return of asset HRM. Okay, the required return of asset if from the 0.09, 0.102, and 0.072. Okay, so after we using that formula, so the final answer for the portfolio is 0.084 or 8.4%. So the conclusion is required rate of return of the portfolio is 8.4%. Okay, the second subcom for this question is explain two limitation of CAPM. So the first one is relies on historical data. The betas may or may not reflect the future variability of returns. Therefore, the required return specified by the model should be used only as rough approximations. The second answer is assume market are efficient. Although the perfect world of efficient market appears to be unrealistic, studies have provided support for the expected relationship described by the CAPM in active market, such as the Bursa Malaysia. Okay, the last subcom question is about do not put all your eggs in the same basket. Discuss the wisdom of this massive, as stated above in relation to the concept of diversification. Okay, the answer I give is the maxim do not put your eggs in the same baskets reflect the concept of diversification and should not put all his wealth into one asset only. Diversification is a risk management strategy that involves spreading investment across different assets or asset classes to reduce the impact of a pure performing investment on the overall portfolio. A portfolio is combination of securities. Combining the securities can reduce or eliminate the risk because the fluctuation offset each other. Hence, investor can reduce the risk by holding a diversified investment. The degree of risk reduction depends on the coefficient of correlations. The lesser the correlation coefficient, the greater the risk reduction of the potential portfolio.
So we move to the question 3, part A, which is we need to calculate the current weighted average cost of capital of Menarik PLC. So the first step is we need to calculate cost of ordinary share, which is 4.5% of the risk-free rate of return plus 1.5 beta times in bracket 12% of average rate return on the stock market minus back 4.5% of the risk-free rate of return. So we got 15.75%. Second step is to calculate cost of preference share by 8% of preference share times in bracket 1 ringgit divided by 1 ringgit 60 cent per share. So we got 5%. Third step is to calculate cost of bond, but the interest was not given. So first thing first, we need to change the payment per year to 2. Since the question already stated the semi-annual bonds, then the payment is 2.5. PV is negative 108. FV is 100. The period is 10. So we got 3.25% of interest bond. Not to forget, the calculation after tax is 3.25% interest time to 75% of corporation tax rate. So we got 2.44%. Next step, we need to find the proportion of all these shares by using each share's market value divided by all the shares market value. So we got 77.1% of ordinary share, 17.1% of preference share, and 5.8% of bond. Lastly, calculate the weighted average cost of capital by adding all of these shares, which includes the multiplication of each their proportion percentage. So we got 13.14% as final answer for this question.
Moving on to the next question, which is explain the difference between systematic and unsystematic risk in relation to portfolio theory and capital asset pricing model. So, systematic risk is also known as market risk or non-diversible risk. It is the risk inherent to the entire market or an entire market segment. It cannot be eliminated through diversification because it affects all securities in the market. Systematic risk is caused by macroeconomic factors such as economic recessions, changes in interest rates, inflation, and geopolitical events. These factors impact the overall market and consequently all securities within it. In portfolio theory, systematic risk is the primary concern because it is the risk that cannot be diversified away. The CAPM specifically focuses on systematic risk when determining the expected return of an asset. So for unsystematic risk, it is known as specific risk or diversifiable risk. It is the risk that is specific to an individual security or a small group of securities. It can be reduced or eliminated through diversification. Unsystematic risk arises from factors that are unique to a particular company, industry, or asset. Examples include company-specific events, management issues, and product-related risks. Portfolio theory emphasizes diversification to mitigate unsystematic risk. By holding a diversified portfolio of assets, investors can reduce exposure to the idiosyncratic risk associated with individual securities. CAPM focuses on systematic risk but assumes that unsystematic risk can be eliminated through diversification, leaving only the market risk relevant for determining expected returns.
Okay, next is a question 3 part B. Okay, the requirement of the question is about calculate the total equity market value of Gaga using the dividend valuation model. Okay, to make it easy to understand, I go to step by step. Okay, the first for step 1 is calculate dividend per share. To calculate dividend per share is earnings multiplied with dividend payout ratio divided to the ordinary shares. Okay. For the 2070, we get the total dividend is 200,000. So we calculate dividend per share is 0.02. Okay, for the total 2080, the total dividend is 262,500. Then we calculate dividend per share, we got 0.02625. Okay, the next step is step 2. Step 2 is to calculate dividend growth. Okay, to calculate dividend growth, I use the formula dividend old dividend new minus with dividend old divide to dividend old. So the after I calculate, the answer is 0.3125 or 31.25%. Okay, after we calculate dividend growth, we move to the step 3, calculate the current price. To find the current price is dividend per share year 1 multiply with 1 plus dividend growth rate divide to cost of equity minus with dividend growth rate. Okay, so I got the answer is negative 0.2259. Okay, last step is total equity value. So to find the total equity value is a current price multiplied with ordinary share. So I got negative 2,259.2020 cents.
Hi, Assalamualaikum. So I will continue with the next question, which is question 4. You are the finance manager for an established electric company. The company is considering replacing the existing equipment used in its manufacturing process. You instructed a junior finance executive to analyze several options and come out with a report to be presented to the top management. 5 days later, you receive a report from the junior executive as follows. So basically, this question is to replace the existing equipment AA with the new equipment BB. And then they also provided a table of details of the expected incremental profit, and then under the table they provided some additional information for us to take care. So this question is basically about the replacement in the cash flow topic. So we already have a fixed formula to solve this question. So first of all, we have to divide into 3 flows of cash, which is initial investment, operating cash flow, and terminal cash flows. So for initial investment, the cost of new equipment is 10 million, which is we can see in the they provided the cost of the new equipment BB, which is 10 million, and then the market value of all equipment, it's stated in the additional information 3, which is they said that the equipment AA, which is the old equipment, can be traded in for 620,000. And then for the tax effect on loss on disposal, we have to refer to note 1, which involves some calculations. So first of all, to compute the tax effect on loss on disposal, we first must find whether we gain or loss when we sell the equipment AA. So first of all, we have to calculate the book value of the equipment AA, and then we have to subtract it with the market value of equipment AA, which is 620,000. So after we compute the book value for equipment AA, we get 650,000, and then we get loss for 30,000. And then for the tax rate, in order to compute the tax effect, we have to first find the tax rate. So how do we find the tax rate? From the table that they provide, we can compute the tax rate by dividing the tax with the profit before tax, and then we get 25% of tax rate. So from the 25%, we multiply with the loss that we get earlier, which is 30,000 multiplied by 25%, and then we will get 7,500 ringgit. And then we go to increase in net working capital as much as 150,000, and then we get the total net initial investment, which is 9,522,500 ringgit. So this is the cash outflow, which is we have to invest, we have to pay, and then we go to the next one, which is operating cash flow. So for the gross profit, they already provided in the table. And then for the admin and distribution expense, they said that 1,400,000 from the admin and distribution expense at first earlier, it will be incurred even if the company decided to continue using the existing equipment AA. So in other words, it wants to imply that this 1,400,000 is actually a sunk cost. So when it is sunk cost, it is irrelevant, and we have to subtract it, and then we will get 1,800,000 for each year. And then for the depreciation of new equipment is also given to 2,500,000. And then for the depreciation of all equipment, we have already computed in the note 1 before, which we get 300,000. And then to get the earning before interest and tax, we must gross profit must subtract admin and distribution expense, subtract depreciation of new equipment, and add the depreciation of all equipment, and then we will get 4,500 for year 1 and year 2, and 4,200 for year 3 and year 4. So from the earning before interest and tax that we got, so we have to multiply with the tax, which is 25%, and then to get the net operating profit after tax, which is we got 3,375 for year 1 and year 2, and 3,150 for year 3 and year 4. And then at the end, we must add with depreciation, which is we compute by depreciation of new equipment, we minus with depreciation of all equipment, and then we get the depreciation that we must add with the net operating profit after tax. And then in total, we will get net operating cash flow 5,575 for year 1 and year 2, and 5,650 for year 3 and year 4. Lastly, for terminal cash flows, we have market value for new equipment, which can be we can get the amount from the question, which is stated that it is expected that at the end of its useful life, equipment BB can be sold as a scrap for 5,000 ringgit. And then for the tax effect, it is also the same like the note 1, which is we have to compute the gain we get from the sale of the new equipment, which is we will get gain for 5,000, and then for the tax effect, we multiply it with 25% rate, and then we will get 1,250 ringgit. And then for the next one is the sale of old equipment. It is also stated in the question, which is if the company does not purchase equipment BB, equipment AA can still be used for another 4 years, and afterwards can be sold as a scrap for 2,000 ringgit. And then for the tax effect is also the same like the note 2 and note 1, which is we gain from the sale is 2,000 ringgit, and then the tax we will get 500 ringgit. And then we put back return of net working capital for 150,000, and then the total terminal cash flows we will get 152,250 ringgit.
So we move to the question for part B. Based on this question, we need to evaluate whether the company should replace the existing equipment AA by using payback period, net present value, and internal rate of return methods. The cash flow is derived from the previous answer. The calculation of payback is 1 plus in bracket 9522.5 of initial investment outflow minus 5575 of incremental operating cash flow inflow and divide with 5575. So we got 1.708 years. For net present value, we just plug in the information of cash flow in the financial calculator and include interest of 15%. So we got 6,573 ringgit and 25 cents. For internal rate of return, just press Shift IRR per year button and we got 46.03%. Thus, the company should replace the existing equipment AA because payback period is less than 2 years, net present value is greater than 0, and internal rate of return is greater than 15%, weighted average cost of capital. Next is question 4 part C, which is we need to explain the advantages of leasing as compared to outright purchase. So, point number 1, full financing is available through leasing. Number 2, lessors have the opportunity to bypass the usual restrictive agreements associated with long-term loans. Number 3, financial flexibility can be gained through leasing, particularly with operating leases. Number 4, depreciating land, which is typically prohibited after purchase, becomes feasible through leasing for the lessee. Number 5, the firm can sidestep obsolescence costs if the lessor underestimates asset obsolescence and sets a lease payment too low. And last point, in the events of bankruptcy of corporate restructuring, lessors can claim a maximum of 3 years of lease payments and the lessors regains possession of the asset.